Hello, boys and girls. I'm Paris, the options guy, and welcome to the No BS Trading Podcast. This is episode number 11 of the podcast, and we are back after 1 week of break because of some technical issues. But yes, this week is going to be very interesting, and the previous week, the end of this week was also very interesting because all of a sudden there are recession fears in the US, and all of a sudden Dow Jones, Nasdaq, S&P, the whole US market is crashing. So we are going to talk about that and what are the implications, how can the US market move from here, and then I'm also going to talk about the how SEBI has released a consultation paper on the FNO market and what are the major changes that could come in the FNO market very soon. And then we are also going to talk about 4 IPOs that are open for next week. So there are a lot of opportunities in the market also, but a lot of things that you need to also take care of. So watch the video till the end or watch the podcast till the end because this is going to be a very interesting episode. But without further delay, let's just start with the episode. Now, a lot of things happened in the previous week, but we are gonna first talk about the SEBI consultation paper that came out in the first half of the week. And if we see, SEBI has talked a lot about how the FNO market has evolved, how the volumes have increased, how there are more expiries, more weekly expiries every week. So the major changes that SEBI is looking to take in the FNO market, those are the 7 changes, actually 5 changes, and the 2 changes after that are not so significant. So I'm going to tell you guys what those changes are, starting off with the biggest and the sort of most important thing which a lot of people might be concerned with is contract size will be increased from 3 times to 6 times. And by contract size I also mean lot size, because if contract size increases, the minimum contract size, lot size will also increase. So you can expect an increment of anywhere from 3 times to 6 times in the lot size of options. So this will be phased first of all in 2 phases, right? So in the first 6 months, contract size can be increased from 2 times to anywhere to 4 times, right? And after that, in the 6 months after that, contract size can be increased further from 3 times to 6 times, right? So this will be a very major change, and a lot of people who are trading with less quantity, like a very less quantity, 1 lot, 2 lots, they will not be able to trade in the markets, right? But still, I'm going to talk about how this is also not really a very good thing to do. So yes, for that, let's just wait. And after that, the second big change is decreasing the weekly expiries per to one index per exchange. So we talked about this a few weeks ago also, where I said that there will only be one index that will expire every week. And so over here also they've said the same thing. So what do they mean by decreasing the weekly expiries to one index per exchange? Is that now you see on NSE there are 4 weekly expiries. Which one? Nifty, Bank Nifty, Fin Nifty, and Mid Cap Nifty, right? These are all of the 4 indices that have weekly expiries on NSE. And on BSE there is Sensex and BankX. So what NSE and BSE will need to do is choose only one from each of these, right? So for NSE, they have to choose between Nifty, Bank Nifty, Fin Nifty, Mid Cap Nifty. Out of these 4, they will need to choose one index which can expire on a weekly basis. And for Sensex, they'll need to choose between BankX and not Sensex, and for BSE, they will need to choose between BankX and Sensex. So in all, we will only have 2 weekly expiries every week if this rule comes into action. So I think this is a good rule, but I would like a few changes in this rule. I think it is better if SEBI says that you can only have two indices expiring every week, or 2 indices having weekly expiries, and that will be enough. Keeping just one weekly expiry for just one index is a little bit less. I think if we go back to before there was a lot of trading, FNO trading craze, if we see, we only had 2 expiries, Nifty and Bank Nifty, and BSE options didn't even really exist, and if they existed, they didn't have like any sort of sizable volume. So back then also we had 2 weekly expiries, right? And both of those expired on a single day. Even if that comes back, I think that is a better option, because I think this will sort of increase the liquidity in the market. So keeping just one expiry, one weekly expiry per exchange is a little bit less. I think they can do with two indices expiring every week. But after that, if you see, they are increasing the margin for contracts which are going to expire either one day before expiry or on the expiry day. So what do I mean by that is that they will increase the extreme loss margin by 3% on options which are going to expire the next day, so basically one day before expiry, and 5% on the expiry day. So if I want to short options one day before expiry or on the expiry day, I will need a little bit more margin right now. However, that margin is not really, I mean, it's not a very big increase in margins, but still people who trade with thousands of lots, they will feel the pain. But someone who is trading with one lot or two lots or even 5-10 lots, I don't think they will really be very much affected by this change. Mostly they will just scale back for a while and then again get back if they continue to make profits and increase their capital, because a 3% or even a 5% increase in margins won't really like it's not the end of the world is what I'm trying to say, and it's not even like it's not anything for most people. So that is something. And then another thing is that the another change is that they will remove the calendar spread benefit on expiry day. So what do I mean by that is, let's say I'll give you an example. Now, what is a calendar spread is that, let's say I have options. I have bought, let's say, a call and a put option, which are OTM, which are going to expire, let's say, 1 month from now. And I've shorted options which are going to expire 1 week from now. So this is a calendar spread where you have options of two different expiries and you made a strategy with that, right? So a very simple, what a lot of people do is that they will buy options which are going to expire, let's say 1 month from now. And so what they will do in the meantime, let's say I've bought a call and a put, right? And so in the meantime, when the market is not moving, what I will try to do is I will also try to short weekly options, because I've bought an option which is going to expire a long time afterwards, and so it is a sort of an OT option and it can act as a hedge. So now I can short options which are going to expire on a weekly basis, or which are going to expire quickly, so that I can capture some extra premium, right? So this is the calendar spread benefit. And what we are saying is that on the expiry day, let's say I have a spread which is, or let's say I've bought a call option which is going to expire on 30th August, right? So, and today, let's say I bought a nifty call option which is going to expire on 30th August, right? And let's say today is the nifty expiry and I decide, you know what, I anyways have this call option which is sort of far OTM call option which is going to expire a few days after that. I can use it as a hedge and short a call option today to capture some extra premium, to get some extra income. Now I cannot do that on the expiry day, because I will not get the hedge or a calendar spread benefit if I try to do that on the expiry day. So not a very big change, but definitely it will affect, I think, a lot of sort of institutions who do this. So for the retailers, I don't think a lot of retailers would be implying this strategy. I think a lot of institutions would be implying this strategy and they will feel the pain for it. But still, it is not a extremely big deal. The biggest deal is, I think, decreasing the weekly expiries, and it is a good change, but I think it is a little bit too much done. Rather than keeping one index weekly expiry, I think 2 is a good number, a very balanced number in my opinion. So that is something. And after that, we have that they will decrease the far OTM option strikes. So up to 4%, we will have the same amount of OTM strikes that we had, right? So let's say for Bank Nifty, what is 4%? It is 2000 points, right? If we assume Bank Nifty is at 50,000. So 2000 points on the put side, and on the call side we will have the same amount of options. But after that, after 4%, after that we will have lesser amount of OTM strikes, because a lot of people buy OTM options thinking that they will triple or 4 times or whatever, and they lose a lot of money. So what these guys will do is that they will reduce the number of OTM strikes in the market which are after 4%, right? So This I think is not really a very big deal, but still it might reduce a bit of liquidity in the market. So again, we'll need to see how this affects. I'm not really sure how the effect of this thing will be, but if they are doing this, I think they are doing this because they are worried that a lot of people will buy OTM option. A lot of people are buying OTM options, so they are sort of limiting the effects, or not effects, but sort of limiting the options that people have. But still, I mean, if we are going to, let's say, for bank nifty, what is the interval? Every 100 points we have one strike. So 15,100, 51,000, 50,900. That is how the strikes go, right? And so after, let's say, even 4%, right? So let's say 48,000. After 48,000, let's say you're keeping a 200 points interval, or even a, let's say, 300 point interval. Even then, I think people will still continue to buy options. I don't think people will look at sort of 100 point gap, but still, I'm not really sure how completely it will affect. So I cannot really comment very concretely on this point. So after that, number 6, we have now these 2 points that I'm going to tell now are not a very big deal. They are sort of done. They are sort of already, so sort of they are happening in the market, you can say, or they are already up to a certain extent present in the market, but still I'm going to talk about it. 6th number is upfront collection of option premium. Now I'm going to tell you one thing, is that there are a few brokers in India who are sort of giving you leverage on option buying also. So what they will say is that let's say option is at 100 or is of 100 rupees. They will say that, buy, just give me 40 rupees and you can buy this option. So basically I can buy 100 rupees option at rupees 40. Now this thing will not happen if they sort of put this rule in of upfront collection of option premium. If this happens, then the broker will need to collect the whole amount and not just partial amount. So a few brokers did this in India, where they gave you leverage on option buying also, right? So again, many major brokers do not do this, but yes, a few brokers are there, and I'm not going to talk about it because I do not support that, because options are already very leveraged instruments, and if you are giving even more leverage on that, it is not great. So I'm not going to tell you which brokers are those. Okay, give me 1 crore rupees, I'm going to tell you then. But yes, number 7th is intraday monitoring of position limits. Now what this is going to do is that it will sort of it might change your margin requirements on an intraday basis. So maybe let's say you have a very big position, and then you might face a little bit of margin shortfall or a decrease in margin that is left in your account, right? So not a very big deal as of now. I think if you could just keep a little bit extra margin, it would just help you, and it will not really be a very big deal. But I think all of these changes are not going to be that effective, because let's be very honest, increase in the contract size by 3 times to 6 times, a lot of people who are losing a lot of money, they are already trading with 5 lots, 10 lots. So rather than buying, let's say, 5 or 10 lots, they will just buy 1 or 2 lots, right? It doesn't really matter. And again, if you see the second thing of decreasing the weekly expiries, it is a good thing, but still you have to understand that people still have 2 chances. People will still have 2 chances every week to lose their money, and trust me, people will lose their money. So again, can't really do anything. One thing that you can do is go on the SEBI's website and give a public comment to SEBI that this is not really very effective. And increasing the margin required, again, not a big deal. You can do that. 3%, 5%, not a very big amount. And I think most people will not even notice this change if this change comes in. Removing the calendar spread benefit on expiry day doesn't really matter. Not a very big cohort of people or a very big cohort of derivatives traders do this. So again, not a big change. Decreasing far OTM option strikes, I'm not really sure, but I don't think that will also really affect. So all of these changes are not really very effective according to me. And I think a lot of people will also agree that these changes are not very effective. Rather, what SEBI should do over here is that they should bring in a product suitability framework. What do I mean by that is that they should check, are you eligible to trade in this product? How will they check is that, do you have the knowledge of how this product works, right? Do you have the knowledge of what this product is? Do you have a proper knowledge, proper information, proper awareness of what this product is? So rather than bringing out all these rules, they should do this and check, do people, if you want to trade in FNO, do you know what FNO is? Do you know how it works? If yes, then go ahead, you can trade in FNO. But if you don't, then don't trade in FNO. I think this can be done with a very simple certification. Let's say if you want to trade in FNO, get the certification. Done. Khatam. And I think if that happens, 50% of people, as soon as SEBI announces that, as soon as SEBI enacts that rule, 50% of people will go away from FNO, and trust me on this, because a lot of people are over here to just make a quick gain. Come over here, put in your money, in the next 2 hours I have 5 times my money, that's it. And so all of these people will lose, leave this space as soon as you put that restriction, because nobody would want to make the effort of getting a certification if they want quick money, right? They will then have other avenues, other places where they can think about getting quick money, like again these betting sites and all that stuff, but we'll not go into that. So this is my opinion on this, but let's move on to now what is happening in the US, because a lot of data all of a sudden is indicating that there could be a recession coming. And I have since the start of this podcast, I've been telling you guys that a lot of things are pointing at the US economy slowing down, and all of a sudden the stock market has realized that this is not a great thing this week, right? So starting off with the ISM manufacturing index, which sort of measures how is the manufacturing activity, and it was at 46.8, which was lowest since August 2023. And since the past few months, this has been always coming down below 50. That means manufacturing activity in the US is still continuing to move down. Again, one thing which is pointing at a recession. And another thing, which the data that came out of unemployment rate on Friday, the July unemployment rate, it came at 4.3%. Unemployment is finally starting to go up. I told you guys again just a couple of episodes ago, I think, or a few episodes ago, where I said that unemployment rate might be ready to rise sharply at this point. Please keep that in mind. So unemployment rate has started to rise. Expectations were that unemployment rate would come at 4.1%, but it has come at 4.3%, and that is one of the biggest things that is spooking the market. Dow Jones is down a lot. Nasdaq is already corrected more than 10% from its high, and it's officially in a correction, you can say. So just a very sort of a data which is telling us that the recession is coming soon in the US market, and a very bad jobs data too. The amount of the, basically you can say, the, what can you say, the non-farm payroll data and all of that stuff. So again, jobs data very bad, but I don't talk about the jobs data a lot, if you must have seen, and that is because the jobs data gets revised every month. And so many times when you see that the jobs data is telling us the market is strong, if you see the next month that jobs data gets revised downwards, that means the number of jobs that were stated previously are now lesser than that. So I don't think there is a big point in talking about the jobs data, but yes. And so all of this is suddenly creating a lot of fear of recession coming up. And because of this, what has happened is that the chances of a 50 basis point rate cut in the September meeting of Fed has increased by a lot, but I would still give it a week or two to properly understand what the market is expecting. But it looks like there is now 100% chance that the Fed will cut rates in September. So I mean, a lot of places in the market, a lot of platforms where people predict how will the Fed cut rates. A lot of these platforms are saying that the Fed will definitely cut rates. A lot of platforms are saying there is 100% chance that the Fed will cut rates in the September meeting. Now, last week we had the July meeting of Fed, and they kept the rates unchanged. So now it looks like the Fed is ready to cut rates, and I think the Fed has gotten a lot of signals today or in this week which are indicating that it is time to cut rates if they want to save the economy. But I don't think this rate cuts will save the economy. Economy will still continue to go down, and we are going to talk about that in the coming few episodes also, how and why that will happen. And one more thing is that because of the JPY carry trade unwinding, now you'll be like, what is this JPY carry trade unwinding? What is this new thing? So I'm going to link down an article that I posted on LinkedIn. You should go ahead and read that. It is about what is the JPY carry trade, how is it affecting the market, and so you will understand what am I really talking about, this JPY carry trade unwinding. And so go ahead and read that article. I will post that, and you will understand that that is also one of the few factors which is causing this sell-off in the US markets. Okay, so yes, that was it for this week. Now let's talk about what is going to happen in the coming week. Now, next week, we don't really have a lot of data from the US market or our markets, but there are just two important data on Monday that you need to look out for. One is the global services PMI, and it is expected to come at 56. But I want to put this into your mind is that always look out for what are the expectations and what is the market actually delivering, because market might even give you, let's say, a reading of 53, which says that the services activity is expanding, but still if it is less than expectations, the market will react negatively. So expectations are that it will come at 56, but as you saw in this week, in the previous week's data, that a lot of things are slowing down basically. So look it out. I think we might see a negative data reading this time around. So if that comes in, then chances are that the rate cut, the chances of 50 basis point rate cut that I talked about just a few minutes ago, that will increase even more. And if that happens, I will talk about it in the next week and what are the implications. And after that we have the ISM non-manufacturing PMI. This, as now we talked about the manufacturing PMI, which is definitely decreasing. If the non-manufacturing PMI also comes down, recession fears will climb even more, and you will see more brutal sell-off in the stock market. Please remember that markets are still near all-time high. I'm not talking about Nasdaq, but aside from Nasdaq, if you see Dow Jones is still pretty near its all-time high, right? If you exclude the fall that has happened on Thursday and Friday, it is pretty close to its all-time high, and even our markets are pretty close to all-time highs. So if all of these recession fears hit, they will not be a great thing for the market, and we can definitely see a very good sell-off. So these are the only two data points that you need to look out for in the market next week, which are going to be a bit important. But aside from that, there is not really anything. So let's move on to the IPOs that are coming in our markets for the next week. Now we have 4 IPOs in which you can apply in the next week. So a busy week in the IPO section, starting off with Seagull India IPO, which has already started on August 1st, but it will close on Monday, that is August 5th. So you can still apply on Monday. So how is the IPO? First of all, let's talk about from the listing gains perspective. Then we will talk about the fundamental perspective also. So from the listing gains perspective, if you see, the IPO is now already only indicating a 15% listing gain estimated, which is very low to take the risk for, right? So from the listing gains perspective, I am not really interested in this IPO, and I don't think, just in one day we will see any sort of very sizable increase in the listing gains. So if you are only applying for the listing gains, skip this IPO for now, right? So what this company does, now let's talk about the fundamental side, because it is a bit interesting. Now this company is an infrastructure construction company which makes, you can say, specialized projects. It makes, like flyovers, elevated roads, tunnels, highways and all that stuff. So it is a specialized construction company, which I like. Companies which have specializations are, I think, one of my favorite companies. But still, it makes these types of projects, right? And so the company has a lot of government, you can say, initiatives going for it, because the government is investing pretty heavily in infrastructure. So that is one of the things that I'm really interested in this company about. Another thing is that the company has an order book of 95, I think 9400, 9500 crores. So if you want to invest in this company, the company is a very good company to invest in, because I'm going to tell you the revenue trends also. In FY22, they made a revenue of 1100 crores and a profit of 126 crores. In FY23, it went up to 2000 crores and 167 crores. And in FY24, they made a revenue of 3000 crores, 3066 crores, and a profit of 304 crores. So a very, very good growth in the company. They have a very, I think, good amount of, you can say, reserves also. But one thing is that they've also increased their debt in a similar fashion, where the debt has gone from 650 crores in FY22 to 1800 crores in FY24. So definitely the debt over here has also increased. But one thing to keep in mind is that the IPO proceeds. Now the IPO is, I think, just give me a second. Yes, the IPO is a 1250 crore IPO, out of which only 600 crores will go into the company. And if they start repaying this debt, if they reduce their debt burden, you will see better margins, better net profit margins also. So I think if you want to invest in this company, invest for the long term, because they have a very good order book also, which will be fulfilled in the long term, and the gains from the order book or the revenues will be realized in the long term, not the short term. So for the long term, the company is very good. The IPO is also priced it is fine, right? It's not the best, but still it is fine. And for the way, or you can say, the things that the company does and the way that the company is growing, I think the IPO is also priced pretty fine. It's not the best, but still it is pretty good if you are trying to find a company. So return on net worth 33%, return on equity 33%, return on capital 32%. Very, very good numbers, very, very good growth numbers also. And debt to equity is also, at the end of the, as I said, 1800 crores of debt, right? So it is not that big. Debt to equity is still 1.17. So it is not very bad. The company is pretty good. I think you can definitely think about investing in the company for the long run. Now let's talk about another very popular IPO is the Ola Electric IPO, and a lot of people are stoked about it. But the reality is, first of all, let's talk about the gray market premium or the listing gains perspective. From the listing gains perspective, if you see, only 12% of listing gains expected in this IPO, 12 to 10%. So from the listing gains perspective, please avoid this IPO. No need to invest, because it mostly may even open flat or at lower levels than the price at which you get allotted. So don't think about investing in this IPO. So this is a 6,000 crore IPO, out of which 5,500 crores will go to the company. So a very good amount of money going to the company. So one thing that you'll see in the Ola Electric IPO, which is, the profit after tax. If you see, they've made a loss of 1580 crores in FY24, and the loss was just at 200 crores in FY21. Sure, definitely the revenues have also grown 50 times in that time. If you see, in FY21 they just had 106 crores of revenue, and in FY24 they have 200 crores of revenue. But still the profit after tax is the loss after tax is still very big. The net loss is still pretty high, and that is one of the most concerning things about this IPO, which I think. And their borrowings are at 2300 crores, but the thing is that they are raising a very good amount, 5500 crores. So I think they will definitely look out to reduce these borrowings. And so for me, what I would suggest is that anyways, the gray market premium is not that high. Anyways, the listing gains is not that high. So doesn't look like the IPO will open at a very high price. So it is very, very certain, or it looks like a very good probability that the share price will correct as soon as the IPO gets the company gets listed. The share price will correct. Now the IPO is being allotted at 72 to 76 rupees. That means it is being allotted as 76 rupees. So the better price to buy this share will be near 50 to 55 rupees in my opinion. The company is in a sector where there is a very good growth potential, but just like Zomato, just like PB Fintech and all of these loss making companies which got listed, I think it is better to wait and then invest in this company rather than being very fast and investing in this company at the time of IPO itself. If you have a very big portfolio, let's say 15 lakh, 20 lakhs, then you can think about applying in this IPO, applying to this IPO and starting to accumulate shares at this price. Then it is fine. But if you don't have such a big capital, right, or such a big portfolio, then it is better to wait, because I think most probably we will get a correction. Even buying these shares at buying the shares of the company at 60 rupees is a much better deal than buying it at this price. So that is for Ola Electric. I would suggest don't rush into the IPO. Wait for a correction, then take a buy in this IPO. That will be the best thing in my opinion. Then we have First Cry IPO. If you would have heard First Cry, they sort of keep a lot of they only keep baby products, right? Everything regarding babies. So the company is raising 4,193 crores, out of which 1,600 crores will only go to the company. A bit less, but still can't do anything about it. So the company is a loss-making company. They made a loss of 321 crores in FY24, but the loss has started to reduce, you can say, because in FY23 they made a loss of 486 crores, right? And if you see, the revenue growth is also pretty good. In FY22 they made a revenue of 2,500 crores, and in FY24 it went up till 6,500 crores. So revenue is good. The losses are also getting in control, so that is a good thing. But yes, one thing is that what about listing gains? So again, same thing with other IPOs. Like other IPOs, listing gains are not that great, indicating 15% listing gains. So from the listing gains perspective, it is better to not invest. However, by the time this IPO closes, which will be on August 8th. So the IPO is from August 6th to August 8th. So by the time this IPO closes, if the listing gains go above 40%, then you can think about investing in this IPO for the listing gains. But by that time, if the listing gains stay the same, don't think about investing in it for the listing gains. So one thing is that the company looks like it is sort of on a, you can say a reversal point, and it looks like the losses might start to get contained now, right? So what I would suggest is that start accumulating the shares. If you have a very big portfolio, as I said, you can apply into the IPO. But if you don't have a very big portfolio, rather wait for the IPO to get listed, then go ahead and buy the shares from the live market, or you can say after getting listed, in a lesser quantity. And once you see a correction, now the IPO is being again, the IPO is at 465 rupees. You will get allotted at 465 rupees. So what I would suggest is start buying shares near 450 rupees, and the best price for this IPO will be somewhere near 400 rupees. I think that is a very good price to pay for the company. The IPO is a bit aggressively priced, I think, in my opinion, just a bit aggressively priced. So if we can get a bit of more, you can say, a discount on this IPO, that will be very good. So rather than buying at the IPO itself, wait for the company to get listed and then start buying these shares, right? And then after that, the last company to get listed or to have an IPO this week is Unicommerce eSolutions. So this is a company which provides e-commerce solutions to a lot of other companies, right? I think it is 100 and actually just give me a second. Yes, they have 101 logistic partners and a lot of things, right? So they provide to a lot of people. They provide services to brands, sellers, logistics, and all of these people. So it is a good place, you can say, sort of, it is a good area where the company is, or a good sector where the company is. And if you see, revenues have been increasing pretty healthily from FY22. In FY22 they had 61 crores of revenue. In FY24 they are now at 109 crores. In FY22 they just had 6 crores of profit. In FY24 they have 13 crores of profit. And out of that, if you see, in FY23 also they had 6.48 crores. So 6 crores, the profit have basically doubled in the last financial year. So this is a very good thing, and because of that the company is looking pretty good. The company has a lot of growth in it, but the major problem that I have with the company is that it is getting listed at a, or the shares will be allotted at a PE of 84.5, which from the industry standards is a bit high in my opinion. So again, they are sort of taking an advantage of saying that we are a company which is in a very good sector, we are a company which is in a very good place and has a very good strong fundamental. Because of that we will take a premium from you. And so in my opinion, rather than giving them the premium, wait for them to get listed and then go ahead and take a buy at lower levels, because I think they are pretty aggressive. The IPO is pretty aggressively priced. And one more thing to keep in mind is that they are raising 276 crores, and all of no money will come into the company. Only the previous shareholders are selling their stake, which is again a bit of a bummer for me. And whenever that happens, I don't really like it. So what you should do is rather wait for a correction, because most probably you will get a correction in the stock. And the IPO is getting listed somewhere near 108 rupees, not listed, but yeah, you will get allotted at 108 rupees if you apply. Buying it near 90 rupees or 90 or 85 rupees is a much better deal rather than buying it at 108 rupees. So what you can do is, if you have a, as I said again, very big portfolio, start buying. You can apply into this IPO, but if you have a small portfolio, allocating the shares of this company in your portfolio, a very big place, would be a bit of a bummer in my opinion. I think if you can get, most probably you will get these shares in a correction also, because most of the IPOs will see a correction, especially the IPOs that are already aggressively priced. So rather than rushing on to buying these IPOs at the, buying these companies shares in the IPO itself, wait for a correction, have a little bit of patience, and then you can take a buying position. So in my opinion, so that is my opinion on this company. As of now, it is indicating a 27% gray market premium, so around about 25% listing gains you are seeing. But yes, if the listing gains goes above 40%, then you can also think about applying it, just to get the listing gains. So yes, these are the IPOs that are going to come next week, and again, a lot of talking and a lot of information over there. But now let's move on to the market analysis for the next week. Now talking about the market analysis for the next week, if you see, Nifty has given a fake breakout over here, and Bank Nifty on the other hand has not given a fake breakout, because Bank Nifty didn't even reach the all-time high. Bank Nifty has just been sort of underperforming Nifty for this whole while over here. So Bank Nifty doesn't look as negative because of only HDFC Bank, which saw a good amount of buying from lower levels today. But Nifty on the other hand, if you see, has given a fake breakout over here, because if you see, Nifty broke out about 25,000, not 25,000 but 24,850 over here. But if you see, Nifty went up also, but opened with a gap down and gave a fake breakout. Now one thing that should happen over here, if this is really a fake breakout, is that Nifty should move down very fast from here, at least till 24,200 or 24,400. But as I said, that it should move down very fast from here, because whenever a breakout is fake, the selling will be very fast after that. So that is one thing. And for Bank Nifty, if you see, Bank Nifty has been taking continuous resistance from 50 and 800. So now Bank Nifty, if it has to move down, it will also continue to move down very fast and go below at least 50,800 very fast. So keep this in mind for both of these indices, that if the selling has to happen in these guys, it will happen very fast, right? So now what you can do in the weekly charts or in the daily time frame, if you see, it the market, if you see in the weekly charts, I'm going to open Bank Nifty, it doesn't look very bearish as of now. Why am I saying so? Is there are supports on the downside, and so Bank Nifty, even if it comes near these supports, what will happen is that the supports will, the supports are so far that Bank Nifty will not be able to break them in one go. It will need to take a little bit of time to consolidate over here and then break. Maybe take a pullback also. And for Nifty, if you see over here, Nifty is looking a little bit bearish, not very bearish as of now. It might go into a consolidation over here. That looks like a much more possible scenario. So for Nifty, for Bank Nifty, as of now, things are not very bearish. What we need to see is how is the closing for the next week. Because if you see as of now, Dow Jones, Nasdaq have closed down heavily. On Friday's closing is heavily bearish in all of these guys. So there is a bit of buying that has come from lower levels. If I could tell you in the 15-minute chart, yes. If you see, there is a bit of buying, but I would not give a, so I will not be very optimistic about this buying until and unless we go above and close above at least like 50% of this fall. Only then only then can I say that yes, the US markets have taken good support. Now we will continue to move. But S&P, Nasdaq much more bearish as compared to Dow Jones, and Dow Jones also not looking very good over here. So what we can do over here is going to be very simple. At higher levels, taking a buying position for now is not recommended, at least until this high is taken out in Bank Nifty. Once we close above this high that has been made, then we can think about going bullish. But yes, until then things will be pretty volatile in this area. If we are going lower, then this area of 51,200 is going to be very important. And as I said in my weekly daily analysis videos also, that if we are not sustaining below this level, we will not see a fall. So only if we start making negative price action below this level, go ahead and take a short position. And same thing applies for now also. And one more thing is that this time if we open with a very big gap down, maybe we might not see buying again coming in from lower levels like we've seen over here, right? This time maybe we might see a very good straight fall on the downside. So keep that in mind also. And below 50 and 200 things become pretty bearish, and market can at least move till 50,800. And if this level is broken and we close below this level, then things will become pretty bearish for Bank Nifty. And Bank Nifty can Bank Nifty can easily then go down till 50,000 also in 49,500. Not a big deal for Bank Nifty at all to do so. So that is for Bank Nifty. Talking about Nifty, now one thing as I said is that once we close above this area, above 5,400, you can say, then is when we will get bullish on the market. But until then, going bullish is not really a good thing. Now for Nifty, if you see, Nifty was in this consolidation, broke this consolidation, closed, opened just at the lower levels and has seen a selling. So now if you open with a gap down, chances are we might not see even a pullback also over here, and we might see a straight fall till at least 24,400 on the downside. So if we open with a gap down, things are pretty bearish, and any sort of negative price action, any sort of negative setup that you see in the market, you can go ahead and take a selling position over there. However, if we open flat and start seeing very good buying and we again come about 24,800, then it is recommended to wait for a while, because then Nifty might again go into this consolidation. But looking at the US markets, most probably we will open with a good gap down on Monday, and then it looks like we might see a continuation of this fall, and this time we might not see good buying coming in from lower levels. So Nifty in the daily charts not looking that good, and looks like Nifty might see a bit of a consolidation over here. If we go below, if we get a weekly closing below 24,200, which in the weekly charts, if you see, you can say somewhere near this area, if we get a weekly closing over here, then things will become pretty bearish, and then Nifty might see an even bigger correction somewhere near till 23,600 to 500 also, and that will also easily be achieved. But for that, as I said, that we need a weekly closing below 24,200. So as of now, the market looks pretty bearish, and the way the US markets have closed, it looks like our markets will also suffer a bit in the coming weeks. But as I said, that things can change pretty fast in our markets or in the US markets also. So do watch my daily analysis videos to get a update about how the market is going to move every day. So yeah, that is all for the market analysis. Now let's move on to the concept that we're going to learn today. Now the concept that we're going to learn today is known as a carry trade. Now what a carry trade is very simple. Let's say I borrow money in a currency which has low interest rates, like the Japanese yen, which just has 1% interest rate. Let's say I borrow money in the Japanese yen from the Bank of Japan, which is giving me money at 1%, and I invest it in other assets which are giving me higher interest rate, like let's say Indian government bonds, which are giving me 7% or 6.5% interest rate. So this is known as the carry trade, and the returns that I generate are the difference between what I am paying and what I am getting, right? Or what the returns I'm getting and what I am paying. So the simple definition of a carry trade is borrowing money in a low interest rate currency and investing it in other high yielding assets. It can be anything: bonds, stocks, maybe real estate also. So this is the concept of carry trade, and one of the most popular carry trades is the JPY carry trade, where people borrow money from the Bank of Japan at very low interest rates and they invest it in other high yielding assets, like maybe stocks or maybe US bonds. So JPY carry trade is so popular that it has $1 trillion of assets against it, taken against it. So people have taken carry trades of more than $1 trillion in the JPY, basically in the currency, in the JPY, in the Japanese yen currency. So that is the concept of carry trade. I hope you guys understood what it is. So yeah guys, that was it for this week's episode, and thank you very much for watching till the end. I hope you guys liked this episode, and I hope you guys learned something new from this episode, and I hope you guys got some useful insights from this episode. But still, if you want something changed in this episode or in the podcast, if you want something added, if you want a new section added, or if you want to learn about something, do let me know in the comments. I will definitely make sure that I add those changes into the podcast. But yes, without that was it for this episode, that was it for this week. I'll see you guys in another week. Bye bye.